Okay. All right, we're going to get started here. Everybody wants to know how to get money and how to raise money and how to make their business more successful. So I guess I should start at the top. Who am I and how can I answer this question about whether your company's investor ready or not? I'm David Walker. I'm a business attorney here in Atlanta. I've been practicing for 24 years now. You can believe that. I didn't always start off as a corporate attorney with my own practice. I started off working with large law firms. I was president of a venture capital firm. I was corporate counsel to a venture capital firm. I helped take a couple companies public. I was corporate counsel to a public company. So I've talked to a lot of investors and I've also been an investor myself. I have my own businesses as well. So I'm very versed on the investor side of life and when it comes to business law. In my practice, we only work exclusively with business owners on business related transactions. We don't do any litigation, divorce, or bad news. So I don't necessarily know how to answer any bad news questions, but I know how to answer a lot of good news questions when it comes to investors. Because if we think about it, investors is what makes our business go round when we run out of money. And you're going to have to get more money than what's in your pocket most of the time. There's not a lot of people out there who can self-fund their business all the way. The best investor to get is always going to be the customer. But, after a while, you run out of customers or you need to get more customers, you need investors. So let's back up. Let's talk about how I got in front of you and what brings me to this current situation. Community Navigator is a program that has been, as you see, powered by the SBA. And the SBA funded this program for local communities to bring in professionals to discuss their business issues. And so these partners, Select Fulton and Greater South Fulton Chamber of Commerce, were able to work with the SBA to present this presentation today. I believe this program, the Community Navigator, the SBA and these groups are considered hubs, and the people who put these presentations on, like myself, are considered spokes, and you, the business owners, are considered the tires, because you make the world go round. The biggest difference between this program and other ones is that they pay me. They pay me to provide this information. So you're getting tuition-based information as opposed to the free volunteer work. There's a series of seminars, in-person meetings, one-on-one meetings that you should become a part of. The website to visit is Navigate South Fulton. You'll see it throughout the presentation. But it's a big thank you to these organizations for pulling this together, not just for me, but also to the business owners that we can provide information to. I do this all day for free, but they made it so I don't have to. So with that being said, I'm going to do the best I can to answer any questions. At $449 an hour, I suggest you put questions into the chat and get those answers, or otherwise you're going to have to end up paying an attorney to provide them. So we have a chat, we have our questions, and we're going to get started. So a lot of times when people think about investors, they come to me and they say, Dave, you worked in the background with venture capitalists and angel investors and all these people. I need some money. I need to raise some capital like quick, fast. It's always quick and fast. It's never like in 2 years or 1 year. They need it quick and fast. And I ask them the same 4 questions that I expect all of my clients to be able to answer. And a lot of times, 99.9% of the time, these people fail in answering these questions accurately. And they look simple, but they're harder than they look. And they take a lot of determination and time and obedience to go through them. And that's what these seminars will be about as I host, is we'll go through these questions piece by piece and try to make sure you can answer them effectively. But you have to say to any investor, what do you do, right? You got to tell them why you're good at it. You got to tell them how much money do you need to the penny. And then you got to tell them what they're going to get for their investment. That's where most business owners tail off. They're like, get something? What you mean? I'm like, well, you ask somebody for money, they're going to get something for their money. Oh, yeah, I hadn't thought about that. I guess I need to think about that. So that's what I'm here for, is to set the context for how you might go out and raise capital. You don't have to be a old company. You don't have to be a rich company making a lot of money. I raised $22 million for a Korean company that had no revenue. They had a bunch of patents, but they didn't have any money. So you don't even have to have that. What you have to do is have a plan, and you have to be confident, and you have to do your research. And every investor is a potential, every person that you interact with is a potential investor. So we'll get into that. But I think before we get into these questions about, whether my company is investor ready, I think this session today, I just want to focus in on this one topic, the investor characteristics. Because as I get to the other 4 questions in later topics and later webinars, this is going to be a common frame of reference. You see, everybody on this call is an investor, right? We invest. We invest our money into children, in my case, in tuition. We invest our money into stock markets. We invest our money in the banks that we select. We invest our money in the charitable causes that we believe in. We invest our time, we invest our energy. And we know we're investors and we know what we want as investors, but for some reason, when we become a business owner, everybody forgets what an investor wants. So I'm the objective party today to remind you business owners how you really feel and how other investors feel. So therefore, when we talk later about putting documents together and things together, you can have a refresher on what it's like to be the person receiving that information. And I think that's been the biggest gap in the people trying to raise money, is they believe in their business so much they forget what it's like when you're telling their business to another person and what that person might be looking for to hear from them versus what they're actually telling them. So let's go over the characteristics of an investor today. Every person that you encounter throughout the day is an investor. You wake up, you see your spouse, investor. You see your kids, investor. You see your mother, father, investor. You shake hands to the person at the parking lot or that gives you a ticket, investor. You walk into the office and see a colleague walking around, investor, right? You go to lunch and you get money or you have a server, investor. You go home and you see the mailman, investor, right? You have dinner with your Thanksgiving dinner with the rest of your family, investor, investor, investor. Every single person is an investor. And they don't come with a sign on their forehead going, investor here, or angel investor here, or I'm interested in investing here. You just got to know that these characteristics are embodied in every person. And so you have to be prepared to always talk about your investment opportunity. You can't wait till there's a room or have somebody come later. You have to be prepared to talk now. You got to have your elevator pitch ready. You got to have the documents backing up your elevator pitch at the ready. And you have to be confident enough to have that conversation with anybody you engage with throughout your day. Everybody that you ever talks to, you should say, hello, Dave, how's the investment coming? That should be the words out of their mouth, no matter what they say to you. So we got to remember that you have to be prepared because every single person is an investor. Now, whether they're going to invest in you or not, it's up to you. But you can't say, well, these people aren't investors. Everybody's an investor and everybody has the opportunity because everybody has these characteristics. Another characteristic is an investor is someone who's supportive of your business. Hey, I like the water business, or I've been interested in the water business, or tell me more about the water business. And I actually have a water business, but most people who meet you are supportive about what you're doing. Very rarely do you talk to somebody and say, what do you do? Say, I do cookies. And they go, oh, and they walk away. And they all go, oh, that's interesting. What kind of cookies? They always have a follow-up. So everyone's usually supportive of whatever business venture you're in, especially if you're an entrepreneur, whether you're at a cocktail party or talking to teachers at your kid's school. They're always interested in what you do and they're supportive. So you're probably going to have their attention when you shake their hand and say, I'm Dave Walker and I sell a bottle of water, or I'm, Sally and I sell cookies. And people go, oh, interesting. What kind of cookies? What flavor of cookies? Even you do that. No one's rude to entrepreneurs who announce their business. You also need to know that people's money flow up and down in their pockets. Like, for example, today I have 5 singles in my pocket. 3 days ago, I had 5 20s and 5 singles. Well, 3 days ago, I was an investor. Today, I'm not an investor. So you have to realize that the people you engage, their money flows the same way. So they might have a lot of money, they might have a little bit of money. You don't know what cycle that they're in. All you know is their money goes up and down. Sometimes things seem more reasonable to them than others. They're not going to tell you. They're not going to say, I only have $5 today, but if you came last week, I would have had it. Some people would have said it, but they're not going to say to you, oh, you know what? This is my money, and this is how my money works. They're going to listen to the opportunity you present to them and decide based upon their money whether they can do it or not. And that's the decision that they hold personally. That's the decision you hold. When you go somewhere and they ask you if you want to invest in something, you ask yourself, how much is it? Well, we're doing roundup for $2 for the kids in Ethiopia. I can do that, right? Or I'm doing $2,000 to build a microchip company. I don't have the money for that. But the idea is that everybody chooses to invest based upon the money that they have in their pocket and their cash flow of their company. And it's important to remember that as a company going out to an investor, that you might be talking to somebody that might have a lot of money right now or very little money right now. And you just have to be conscious of it as you listen to what they're saying and what they're doing. And you sometimes have to ask, do you have any money right now for investing? And they're like, no. Okay, this is not going to be a very long conversation because I'm looking for investors. But you still must go through the process, because even if they don't have the money, they know people. So a lot of times I'll tell people who are going to raise money, start with your family. And I'm from Detroit, and they'll say, Dave, I don't have any money. My family doesn't have any money. I'm not going to start with them. That's a bad analogy, because even if they don't have the money, they know people who might have the money. And if they feel like you're prepared and you have all the questions that you need, they will go out and promote your business for you. Hey, Dave, I don't have the money, but you know what? I know X, Y, and Z who does have the money. I'm going to introduce you to them. So don't think that anybody who just doesn't come out wearing their diamonds and driving a Lamborghini aren't investors. It's not true. They just, even if they don't invest, they might know someone who does. So understand that everybody's money is different and it flows up and down. A lot of times, all of us are looking to make more money than what's in our savings account. So if I have $100 in a savings account, in 1 year, I'll have $103. Well, that's not attractive to me. If somebody shows me how I can give them $100 now, and next year I'll have $150, I might listen, because I'm trying to do better than what my current savings account is. And if I got $5,000 in my account and it's only earning interest of 3% every year, but if I can take 2,000 of it and put it in a technology company that's going to pay me more than that over long periods of time, then I'm interested, because now I'm making more than I would make in a savings account. If I'm making less money than I would in a savings account, I'm not going to invest, because I could leave it in my savings account. If I'm going to put $100 in and have 103 next year, that's better than putting $100 today and having nothing next year. So you have to try to mentally overcome what happens if I do nothing syndrome for an investor, because that's always in their pocket. How about no is their answer, right? You've been to those timeshare things where they try to get you to invest in timeshare. You go in, no, no, no. Then you hear the bells ringing and all of the other things, and people like, oh, so and so is a new part of our new, special. And you go, oh, hear that over there? You can be just like them. They're trying to convince you that you can save more money long term than what's in your pocket right now. And that's all you do as a company, is you're trying to convince an investor that your money's better with me than it is with the bank, right? Now, who doesn't want to hear that? Everybody wants to hear that. Again, these are things that people who are going out to chase money forget that people care about. So what's the next topic here? And again, if you have any questions, please feel free to leave them in the chat. I mean, we will address them accordingly. So if I say something that strikes you or you want to comment on, raise your hand or hit it in the chat. Okay, so we also now have a new problem: rising inflation, right? If you had 10,000 in your account before the pandemic, it ain't gonna get you the same thing that it would have gotten you then now, right? I mean, we all know that. We see it in the grocery store and everywhere else. Well, guess what? Your $100 in the account, when it becomes $103, it can't help you as much because your savings only went up $3, but inflation went up $10. So now you've actually lost money because your company, your money in your savings account didn't match inflation. So of course, anybody who says, hey, I got $100, I'm going to make more than savings here and I'm going to be able to beat inflation, that's where I'm going to put my money. And so you got to remember that when you do your business is the cost of inflation and how it affects what you're going to offer your potential investor. But they're thinking about that as well. I got 100,000 sitting into an account somewhere and I'm earning interest on it. But man, it's the inflation cost is going up so high. I would love to invest some of it in a startup and then maybe get 300 or 400,000 a little bit later. So you want to remember that, that's always in their mind is that their money's sitting somewhere. Even though if it is in the savings, they want to kind of move it so that they can get more than what inflation is, but it needs to make sense to them. It has to be smart and it has to trigger the inner feelings, which is the last point on here. We'll talk about that inner feeling that it needs to trigger. Let's see here. What's the next topic? I don't really know these. I just put them up and then we go through them because I enjoy life and I like randomness. But when I made this, I didn't exactly memorize them all. I just, put down some bullet points. But I like doing it this way. It surprises me, keeps me on my toes, right? You can't be a business attorney and come in with a PowerPoint that you've already studied. I want to make the PowerPoint in front of you, show you what a good attorney I am. Anyway, another important point to remember for the investors, they do not want to lose their money. You don't want to lose your money. I don't want to lose my money. An investor does not want to lose their money. If they even think that they could lose their money, they're going to go somewhere else. If you went to a bank and the bank was like, hey, give me $100, I might be able to get you 103. And then again, I might be able to get you nothing. They go running, right? So we want to remember that nobody wants to put money into something that they're going to lose. Now, could you lose money and then recover money over time? Absolutely, right? Hey, investor, we're going to lose money first, but we're going to catch up over time. That could be explainable. But they don't want to put it in and lose money. They also don't want to put money in to pay somebody else. So, hey, let me get $100. What are you going to use this for? I'm going to pay Paul. Really? Yeah. I owe Paul $100. Okay. How are you going to pay me back? I'm going to get it from Peter. Right? Peter's going to give me your $100. I'm going to give it to somebody else. Nobody wants that. You don't want it. I don't want it. I want you to sell your widgets, your water, your cookies, and make me my money back with interest, better than inflation, better than savings. So no, I don't want to lose it though. You don't want to lose it either. Okay. I want to know when I'm going to get my money back. So I'm going to give you this $100. The bank says I'll give it $103 back in a year. When are you going to give me some money back? Some of it, all of it, a little bit of it. These are questions you would want to know. Somebody asks you to borrow you 20 bucks. First question is, when am I going to get it back? Well, get it on Friday. Okay, I got it. If someone says to you 2028, you're like, wait, what? 5 years, 6 years of my money back? What am I getting in? Am I going to get $20 after 6 years? I'm losing money. I could have put it in savings. I could have done other things. So making sure you realize that people want to know when they're going to get their money back. It matters to them. It doesn't matter to you because you just starry-eyed and believe in your business and dump it in and hire people. But they want to know, hey, what based upon your numbers, when am I getting my money back? When is that coming back to me? Everybody wants to know that question. Don't forget, these are all in common interest in just people and all investors. They might make sense, but I promise you when you're doing your business plan, about to talk to an investor, you forgot about some of these. So another thing is not interested in working for your business. Okay, now that's an important point, is that these business owners or excuse me, investors are not looking to come and help you and work with you and do your business. If you sell cookies, they don't care. They don't know how to sell cookies, but they don't plan on selling cookies. If you do law, they don't want to help you with law. If you do water, they don't want to know about water. They want you to do it. So any sort of suggestion that, oh, you can come help me, or I need you to be in the business and help me, that's a turnoff for an investor. Why? Because like the bank doesn't come to them and say, hey, I'll give you 3% interest if you open up the bank today. If you come outside and watch the bank for a couple hours, I can make sure you can get your money back. No, they're like, look, that's part of that money that I'm giving you for. You got to figure that out. So stop offering investors positions in your company to help you. That's a so separate, relationship. You can actually go to our prior class for that one. But the idea is that, stop trying to bundle what they can get out of your business or help you with when you're asking for money. Be very clear. I don't need you to help me in my business. I need your money. And here's what I'm going to use your money for. I don't need to borrow your car. I don't need to use your house. I don't need to do any of that. I just need you to put the money in to do these other things. The investor doesn't want to do it, and you don't want to do it. Oh, we got 3 chat questions. Let's see what we got here. Let's see. If I lose money in an investment, can I write it off? No. So what happens is, investing is what we call, post-tax money, meaning that you've probably already been taxed on it, but you don't lose write-off losses in the company because you invested your money. You only get to be taxed on the amount you made in excess of the money you invested. So can you write off your trip to Vegas because you blew $5,000? No. I'm like, oh, but I thought I was going to win. So same thing in business. They're not going to let you write off your investment. You tried your luck. You tried to make more money than what you started with. It didn't work. Good luck next time. So you cannot write off your investment. However, if you go to Vegas and you lose 5,000 one day and you win 10,000 the next day, you get to say, hey, I lost 5,000 yesterday, so can you only tax me on 5,000 today? Same in the business. You put 5,000 in, they pay you 6,000 back. You only pay taxes on 1,000. Okay, so you can recover your money, but you're not writing it off. Which is the better investment form, debt or equity? It just depends on your business. I mean, if the general rule is that if you can pay back the money based upon your projections with your financial person within a year or two, then it's probably better to just borrow it. If, however, your business cannot take the stress of some amortized payments or monthly payments over time, and that you would really like that time to do research and development and other things in the business, then you might offer equity because it's going to take longer for the money to be paid back. So if you are a business owner, you got to assess, how are you making money? How quickly is the money you offer going to flip into some profit and revenue, and then determine based upon that how you're going to pay that money back in terms of a note. If, however, you're like, no, I just won't be making money for 2-3 years, it's just the way it is, it just won't happen. It's okay. Investors get that, but they just want to know, when then are you going to make some money? And then what am I going to get at that time? I don't want an interest payment over 5 years. I could do that by putting my money in a savings account. I want to know, hey, I'm going to make even more than that. I want to participate on the upside. So I'm going to want equity in those situations. But that's one of the things the attorney can help you with, is determining what's the best investment security you can offer investors based upon your current business model. Another question is, what if it's a donation? There are no donations in business. There's only donations in nonprofit law. So when somebody gives you money, it's either one or two things. It's either revenue to your business in which you have to pay taxes on, or it's an investment, right? Or I guess it could be a loan that you can repay. But there are no donations in business. There's only in nonprofits. Businesses make their money by selling products and services to customers. Nonprofits they don't make their money, but they raise money by getting donations that the people who donate can write off. So if we go to the nonprofit sector of law, which is I'm not a part of, I'm all for profit attorney, profit only, no nonprofit. Nonprofit is a whole separate legal category. But over there, you can write off donations, right? You can raise money by people donating to it, but they're not making any profit. They're taking their money, spending it out, and putting it into other social causes. They're not profiting. We're here to make profit to pay your rent. Okay, so they're not going to be taking any donations. They're going to buy a service or product in exchange for money. Now, if people give you money in your business, they don't want anything for it. It's just revenue. So if somebody comes up and says, I like your business, here's $100. That's revenue to you, even if you didn't provide them a service or product. But you don't get to say, well, that's just a donation. And that person doesn't have to get to walk off and go, I'm going to write that off. I gave that person $100. It's not how it works. We're for profit. How do I determine the valuation for my company? This is a very loaded question. That's part of our series you'll have to come back for. The word valuation by itself needs to be broken down before I get into the details of how to determine it. So good question. Valuation means what's the value of my company? The question is, why would you need to know that? And two, when would you provide that information? The answer to both of those is not today and not now. So that's going to be the thing. You have to register for our classes, navigatesf.com at the bottom, hit that, and you'll be able to participate in some of our future classes where we will discuss things like valuation. But you should always keep in the back of your mind what you think the value of your company is, and there's ways to determine that. When someone invests in my company, are they an owner? It depends. If you don't tell them that they are an owner, then they're not. I mean, it's just somebody gives you money and you don't give them any paperwork suggesting what it is, the court's probably going to rule it as a loan, right, and tell you to pay it back. If somebody's investing in your company, it falls in under what's called statute of frauds, and you have to have a security. That's the stock, the promissory note, whatever it is, the convertible note to give to them. That makes it an official investment, and that's when they've assumed the risk inside of your business. There are ways that sometimes people can give you money and the courts can deem it as an investment versus a loan or something, but those are very special circumstances. But when somebody becomes the owner of your business, the question is, how much of your business do they own? And that's really why you got to have it written down, because it can be a lot of arbitrary interpretations of what did I try to acquire in this business. Did they do it because they loaned you money? Did they do it because they were just looking for a long-term investment? And then what was your expectation? So you got to kind of have a meeting of the minds of what makes sense when it comes to the investment. But ownership has different layers to it. There are non-voting owners who just basically participate based upon their percentage of ownership and the profits and losses. And then there is voting, where they actually get to elect officers or directors or managers, or they get to participate in the the high level operations of the company as determined by their operating agreement or their investment documents about what they can and cannot do. So they're not an owner. So we can go on to this, the next topic here. Let's see. Nope, don't want to give that away yet. Let's go to this one. They're not interested in funding ideas. Okay. So imagine you and your friend sitting down and they're like, hey man, I'm going to build, a paper clip stapler. What? A stapler made out of paper clips. Yeah, that's a crazy idea. Yeah, I'm going to need $500 to get it started. No one wants to invest in your ideas. So a lot of times people will say, I have an idea. What's it worth? I say, it's worth nothing. In America, ideas are worth 0.0. You have to actually go out and make the paper clip stapler. You actually have to go out and make the product or the services for the America to recognize it as a viable business to invest in. So when you're going out to investors and when you're going out and talking to people about what is going to take money into their company, into your company, you need to have an existing business, right? You can sometimes sell concepts like, hey, I have the engineers to build this building. I have the land under contract. This is going to happen later. But most investors aren't interested in giving you money so you can think about what you might want to do later. So just know that if somebody came up to you with an idea, You might yes or no it, but they go, give me money for it. You're like, nah, I'm not doing that. It's just an idea. And we forget that is sometimes as business owners is that part of what you're selling sometimes can be an idea, but recognize it. Hey, I know you don't know a lot about this industry, but let me tell you what's happening. Or I know you don't know a lot about what's happening in this sector or across the nation or across the world, but let me explain it to you. So you have to sometimes let people know it's not an idea. It is a value proposition there for a business that they want to be a part of. So having the time and the energy to spend on teaching them about the industry is important to an investor. They want to know more about it. They want to know more about if you're doing bottled water. Like one of the first things I have to tell people is the freshest water you can ever get is putting your lips in the stream. But we don't walk around with streams in our pockets when we get thirsty. Therefore, someone has to process it and put it into a bottle. If it's processed once and gets put into a bottle, that's called spring water. If it gets processed twice, first by the city, then by a private entity, then that's called purified or drinking water. Something simple like that takes you from, oh, I have an idea of starting a bottled water company and people know nothing about it, going, oh, I see now how bottled water works. You have to learn to educate in your fundraising so that people can have more information about what they're investing in. Obviously, people who know more about bottled water, better investors. People who have no idea, longer story, longer timeline, longer elevator pitch, but still an investor. So just be conscious that not everybody you talk to understands your industry or understands where you're coming from or some of the things that you might determine, oh, this is a no-brainer. You got to tell them why it's a no-brainer. It's a no-brainer because I bottle water at 70 cents a bottle and I sell it at $1.50 a bottle. Oh, no brainer, right? So those are the kind of things that you have to be able to convey to people, every single investor you run into about your fund, about your idea. Okay, last but not least, this is the most important characteristic of all investors, including you and your mom and your sisters and your brothers and your spouses and your coworkers and your investment bankers and your bankers. This is the number one characteristic of all of them. And I'll challenge them to tell me otherwise. They're all greedy. They all want to make more money than they have already, and they want to see more money than they have already. It's the nature of investing. You want to be part of something, and the more you greed factor that gets higher, the more you want to invest. The lower your greed factor, the least likely you are to invest. So how do you make investors greedy? You have to show them that with or without them, this business is going to be successful. If they feel like a business is going to be successful with or without their money, they get greedy. If they feel like they need the help, the idea has not been explained, they're going to lose money, it's not going to beat inflation, they don't have the cash in their pocket, none of those things trigger greed. Greed is triggered by, I see something, I see a train going up a hill to the magic golden land of money, and I need to get on that train. You got to create that imagery for them. If they see a train just moving along or about to jump off a cliff, they're not going to invest because that's charity. That's donations. That's, oh, you're going to not make it. Let me give you some money to help you. So you have to remember that every investor is greedy. And it's okay. We're in a for-profit business. It's capitalistic. This is the area where it's okay to be greedy. The key is, how do you trigger their greed? And there's ways to do that. There's ways to trigger them. The biggest way is the confidence. You knowing your projections, you knowing how you're spending your money, you knowing the team that you're going to hire or have hired, you knowing your sector and your experience in your sector. These are all factors, and we talk about them as this course goes along, that goes into triggering the greed gene. Now, once the greed gene is triggered, and once they've determined that this is something that I'm very, very much interested in, it's explained to me very well, it's something I enjoy, it's something I enjoy being a part of, and I feel like that I can make some money off of this and I can create my greed factor. It's our job as an attorney to put that in writing. Okay, here's the contract for your greed sum. You're going to put in this much money and get this much return for being this greedy. And that's really what investors want. is they want you to sell them to the point where they get greedy and then give them paperwork that backs up their greedy assumptions so that they can put their money in. And then they want to move on in their life and keep checking back to see if their little seed that granted current that they planted grew or if it fizzled away. And your job is to convince them that you have all the nutrients to make this seed grow, all the nutrients to bring money off the money tree that will grow from it. And all you need to do is activate that with their money and the help of others to get it started. This is just the beginning of the mental process it takes to raise capital. But you have to remind yourself of all these points when you're preparing your business plan or your investor documents or your pitch or whatever. You have to sit on the other side of the audience and say, does this presentation check all these boxes? Because if it doesn't, you're not going to get an investor. All these people will move on with their life because there's other things to do. There's savings accounts out there and that they can put their money in and they're going to keep it going. So what my job is throughout this course is to try to get you comfortable with the idea of presenting your company to investors, get you comfortable with the information and how to gather the information that's most valuable to the investors. And then, of course, show you some of the documents and some of the strategies to offer them when it comes to closing on investor documents and making sure you have the right investor. So that being said, I'm opening up to any questions that you might have. We'll go back to the chat. Let's see. How long can an investment be for? Oof. I mean, it's really up to what your investor audience and what your projections look like. So I've seen it where the investors, didn't get their money back for 5 or 6 years. It's not recommended with unsophisticated investors. Usually you want to try to focus in on about 3.5 to 5 years before they start to get their money back. You want to have people to at least get some money back in about 3.5 years. And then, obviously start to get into the return on investment after that. But there are other ways that you can promise them. You can say, hey, I'm definitely going to pay this percentage back within 2 years. And so you borrow it or et cetera. But how long the investment is going to go for is depending on your individual business model. And it's really just explaining to the investor why it's like that. So if you have other businesses like real estate telling people, hey, you give me 100,000 and I'll have you 120,000 back in 90 days, you might have a hard time explaining when you want 100,000, that's not going to be repaid for 3 years. Like, wait, people down the street telling me they're doing this in 90 days and you're telling me 3 years. Why is that different? So you got to be conscious of, what your industry is doing and with their investment as well. And don't just, well, I think it's going to be 3 years. And then it turns out nobody's investing with you because they think that's too long. So what we try to do as the attorney is to try to make it reasonable in light of what your business is trying to do. Investor money is more expensive than customer money. Obviously, if you sell a service or product, the customer gets the service or product, walks away, you got the money. Investors, they're there. So one of the things we're going to talk about during this course is using the same intensity to update your investors as you did to solicit them, right? A lot of times people invest and then you forget. You told them all these wonderful things and stuff. You don't provide updates. You don't do quarterly updates or annual updates, even letting them know, hey, this is what's happening with the money. This is where things went. A lot of people have bad news happen. They don't want to talk to the investors. Oh, we missed our deadline on this contract. I lost this contract. I tell them right away, tell the investors, I don't want to do that. The investors are investing. They're smart enough to know things go up or down. But if you do need more money, guess who got to give it to you who's already put money in? Your investors. So don't be afraid to be transparent with your investors about the status of your company. They all like that. They all like to be, oh, okay, how's that going? Go from there. What are a few resources to help find investors? From Jeff. Jeff, you missed the opening sentence.
I did. I just came on at the bottom of the hour. My bad.
Okay. No, it's not your bad. I think that's a fair question I talked about earlier. It's basically everybody you shake hands with or wake up to, Jeff. There really
love it. Okay.
Sort of, general pool of investors sitting around there that people go to. Now, there are ways, depending on your business model, to target certain things. So, for example, if you were in chocolate and you were doing a chocolate cafe or something like that, then you might want to go to a lot of conferences that talked about chocolate and talk to people there and tell them. But every person you shake your hand with is a potential investor. But there is no,
Got it.
think about you being an investor. You just sit around with a bunch of people with investor on your forehead and go, waiting for somebody to come and say hi to me.
Right.
That's not really how it works. A lot of times people who do invest, you find, you talk to them in the elevator, a coworker, a cousin's friend, somebody else's spouse who learned about it, or a coworker or a truck driver that drops off deliveries, cousin wants to invest. So you just have to be investor ready, because there is
Gotcha.
no like set group of investors just sitting there.
Got it. Thank you.
Yeah, there's no such thing as a silly question. There's just ill-timed questions.
There we go.
No, listen, this is not easy. The hardest thing about raising capital from investors is that you have to do it in parallel with your business. You cannot pause your business and talk to an investor like, okay, I know we're making chocolate here, but we're going to stop because I got some investor meetings, and then we're going to come back in a couple months. No, because your investors will ask you, how much chocolate did you make today? And you're like, today? Like, yeah, well, I stopped because I was looking for investors. I'm losing my money, I'm leaving. So you have to keep making chocolate while you're trying to go out and get investors. And that's the hardest thing to do. And that's what my job as an attorney is, to try to help minimize that, or at least prepare you for that journey, because it takes a lot of energy to raise capital while you're running your business. But you have to. You don't get to say, oh, I'm going to put this on hold, or I'm going to do this later. Now you can say, I'm not going to pursue this until I get money, which is fine. You have your list of wants and your list of things that you like to get out of your business before you go out and raise money, but you don't necessarily stop, and say, hey, I'm just not going to do anything until I get investors, because investors ultimately will want real-time data. Hey, can you send me your last 2 months financials? And my clients hate that. They be on the road talking to people to get them close a term sheet, ready to go. And they say, can you send me your last quarter financials? And they know it's been bad, right? Like, oh man, I gotta now talk to my accountant, but I've been talking to this person for 3 months. They want the last 3 months of financials. I'm like, that's just the way it works. They want to see what you've been doing over the last 3 months. They didn't tell you that 3 months ago they was going to ask for it, but they're perfectly entitled to it right before closing to see what you've been doing up to closing. So I try to tell people, don't stop when you think you have an investor. Go even harder.
Great. Thank you.
Okay. What are some of the things we should avoid as business owners when trying to raise capital? For example, why are merchant advances bad? Can they ever work? Merchant advances. Oh, wait. So let's back up. Are there some things to avoid when trying to raise capital? Absolutely. There's definitely bad term investments, or this is the worst thing to do, is when people tell the investor, well, what do you want? I'm like, don't ever say that. You ever go to, Kroger, you pick up a candy bar, go to the counter, and they go, how much do you want to pay for it? And they go, no, this is how much it costs. So getting my business owners to make affirmative stand. Hey, I'm offering 10% of the company for $10,000. This is your opportunity, yes or no. A lot of them will go, I need 10,000. I just asked the investor, what do they want for it? Like, do they want me to come over and clean their house? They want like no, don't do that. You talk to people in affirmative when you're the business owner. This is your company. This is what I'm offering. If you don't like it, make a counter offer. But this is what I'm offering. So that's a bad way to raise capital, is when you open it up to investors choosing what they want and makes what's going to make them feel comfortable. Don't ever do that. You tell them this is what's going to make you feel comfortable, and here's why. Merchant advance is bad. So let's talk about what they are, and then we'll talk about whether they're bad or not. Merchant advances are these companies out there that will loan you money up front, and they'll either take it weekly out of, sometimes daily, out of your bank account, or they'll take it from your credit card sales. As your credit cards come through, they'll take all your credit card money because they gave you money up front. Can that be bad? Absolutely, they can be. Because let's suppose someone gives you $10,000 and say, I'm taking out $1,000 for the next 10 weeks. You might think, or let's say they're taking out $1,000 for the next 11 weeks because they want interest. You might think, great, I could use 10,000, and they'll do it quickly. Next day, a couple days, here's $10,000. Well, guess what? you take that 10, you buy this, you buy that, and comes Friday, $1,000 gone. Well, you bought some things, you're down to 6,000, so now 5,000 is out. And so you got 5,000, you go and do a couple other things, you got 3,000. Then the next week, another 1,000 come out. Now you're down to 2,000, but the things that you worked out in the last 2 or 3 weeks haven't been really paying money yet. So now you're in the third week and another 1,000 comes out. And you guys know where this all goes, is that they take the money out so quickly that you don't really get 10,000 for a year. You really only get 10,000 for a couple of weeks before they start digging into that money again. So that, if you're not aware of that, then yes, because you should only take that money if it's going to make more money than what you have to pay. So if I have a truckload of water that costs me $10,000 from my bottler, and I'm going to sell it for $15,000 in less than 5 weeks, that might be a good deal for me, because instead of me waiting until get the money, I can take this 10,000, I'll pay for this truck, I'll have this truckload sold, I'll have 15,000 back. And then as they start taking their $1,000 out, I've paid them back. So unless you're using it for what we call accounts receivable or projects you know are about to make money in the future, then no, you don't want to do this. You don't want to take these advances to pay for things you owe money for. You want to take them to invest in projects that you're going to get more money from, because you got to not only pay that 10 back, you got to pay it with the interest in a short amount of time. When my truckload's coming in 30 days and I'm going to make $5,000,
So you're
I'm
going
going to
to
get paid in 30 days. And if that happens, I
I don't
can
need
then go
anything.
on to
I
pay
was just
back
seeing where
this
you was
loan.
going.
The key is to not take
Bored.
those when you were in
Bored
big
already?
trouble or owe other money, because you can get into really bad circumstances quickly. And there are some organizations out there that can help you manage this if you found yourself in that position that you've taken these advanced loans and they're taking money out of your account. But I'm beginning more and more of those phone calls over the last 2 years. Before that, I never hardly got them. Now, these companies are taking money out daily, outrageous amounts, and their people are falling for them because they're big. They're like, how about 100,000? Like, oh, I could use 100,000. They're like, yeah, we're just going to take out 2,500 every Friday. And people think like, okay, 100,000, 2,500 every Friday, that's fine. But when they get the 100,000 in their account, they spend it, and that 2,500 comes, and these people will sue you. They'll shut down your credit cards. They'll do all kinds of things to make you have to pay this money back. So I think you should just talk to your financial advisor and your attorney to see if the right loan is good for you. Let's see if there's any other questions in the chat. Okay. Having not seen any other questions in the chat and having been exhausted for being in this closed room to do this Zoom, I am going to start to wrap it up with, again, acknowledging all of the people and the organization that made this possible with the Community Navigator and the SBA. Again, go to navigatesf.com if you want to register for more of these classes. This is just the first of many to come. We also will have some in-person webinars as well as some one-on-one training. So if you are actually going to raise capital, you might want to go through there and follow them very closely so you can register. Again, this is something that the SBA put together. Hopefully you can feel the excitement in my voice as I'm offering you professional services, and my colleagues that are also part of this program. We are thankful that we're getting paid for our services, but we take our businesses very seriously. Without any business owners, there cannot be a business attorney. So I myself take it personal. And I'm here to help, and I'm here to answer questions and to share all of my knowledge the best I can to help you advance your business. And I appreciate everything the SBA, South Fulton County Chamber of Commerce, Greater South Fulton Chamber of Commerce, and Select Fulton have done to bring this all together. It's a fantastic organization, fantastic people making this happen, and business owners, you should take advantage of it as you go forward. I think there's one more question that popped up. Great to meet you. From Detroit. I am from Detroit. I did grow up there. I came to Atlanta in 2004. So I've been
all right,
here
Dave. I look forward to meeting you.
Yeah. Okay. Well, anyway, everyone, that concludes our session. I'm going to stop the recording. I guess the recording will be available at some point in time, but have a fantastic day and we'll go from there.
All right. Thank you.
All right. Bye-bye.